Good afternoon, ladies and gentlemen. My name is Michalis, and I'd like to welcome everybody to this afternoon's webinar here at HF Markets. Today, we're going to be looking at interest rates and interest rate decisions from this week, because we've had a major week with a lot of news, a lot of different aspects being spoken about in terms of the monetary policy, in terms of interest rates, and of course, inflation. This week alone, we have seen a lot of talk, a lot of different forward guidances and amendments to what the monetary policy is going to look like in 2024. For example, we've had announcements from the Swiss National Bank, we've had the announcements from the European Central Bank, the Bank of England, and of course the Federal Reserve. So of course, this is a major announcement. And of course, it's something that everybody is going to be looking at going forward over the next couple of months. So, ladies and gentlemen, let's start looking at today's webinar. Let's just wait a couple of seconds to ensure everybody has joined today's webinar. Great. So everybody, today we're going to be looking at bullish markets. We're going to be looking at what currencies are going to be bullish, what currencies are going to be bearish. And of course, we're going to be looking at the reasons behind that and why have analysts and economists and central banks set a certain path for certain currencies. Now, before we start to look at what are interest rates, what are central banks, and look at the basics of the market, and then start to build into what is actually going to happen to interest rates in 2024 and what type of ripple effect it's going to have throughout the market. Because of course, as interest rates change, it creates volatility in the market, and we need to know how we are able to take advantage of that volatility. Because if we're able to successfully identify how the market is likely to move in a specific period of time, it's at that point that, of course, we can take advantage of the price movements and speculate the price movements and potentially profit from these price movements. But before we start to look at this, very quickly, I want everybody, of course, to be aware that here at HF Markets, we are, of course, dealing with investments. Now, no matter what type of investment you may be looking at, whether you are trading currency pairs, stocks, indices, or gold, whatever it may be, it is an investment. So no matter what happens, there's of course always a certain level of risk involved in the investments, as with all investments. And it's important for everybody to understand this, to be comfortable with it before proceeding to a full investment. So this is what I wanted to mention as part of this slide here. Now, also a little bit about myself. I don't want to spend too much time on this slide because I want to start to get into more details about the basics of interest rates, central banks, what has been said, to analyze the market and look at what is potentially likely to be the prospects of 2024. But I tend to get a lot of questions, so I do think it is important to know a little bit about the individual who is providing you with this information. So my name is Michalis. I'm the market analyst here at HF Markets. I have been in the market for almost 10 years now. Originally, I was a financial advisor in London for 4 years, and I've been a market analyst now for over 5 years. I don't want to spend too much time as part of this slide. I am also on the regulator's website. If you go to our regulator, here in Europe, that is, and you check under the list of approved and certified advanced certificate holders, you can see that I am on that list. Now, the main thing I want people to understand is that, of course, this webinar and webinars in general, people sign up to HF Markets, you have easy and quick access to many webinars, which are all there for educational purposes. And of course, you have access to this free of charge in order for you to grow, to learn, and become more experienced as a trader. Of course, as part of these webinars, we're not here, even though I've been a financial advisor in the past, I'm not here to give financial advice. But what I do want is to give as much educational material as possible in order for you to be active in the investment market with expertise, with knowledge, and with confidence. So the first thing I want people to understand, because of course, if we've got experienced traders watching today's webinar, they will know everything on this slide. But before we start to look at what is going to happen in 2024, what have central banks said this week, which is creating so much volatility. For example, if we're looking at the Dow Jones is at its highest that it has been ever. We are at an all-time high. If we're looking at the Nasdaq is at its highest that it has been ever in 2023. The Nasdaq this year alone has increased by almost 55%. So what is creating this volatility? How can we take advantage of this volatility? And what is going to happen in the first quarter of 2024? But in order for our new traders to understand this, we of course need to get a decent understanding of what is interest rates and what are central banks, and why is it having an effect on the financial trading market and its assets. So the first thing that everybody needs to understand, a central bank is an independent institution that is given authority to manage the country's currency and monetary policy. So let's break down that sentence into three parts. The first thing people need to understand is a central bank is not like a bank which you personally go and bank with. The central bank is actually the regulator and actually the bank where your bank borrows money from. So each country will have its own central bank. So for example, in America, we have the Federal Reserve. In the UK, we have the Bank of England. In Europe, we have the European Central Bank. Now, the central bank, like I said, it is a regulator, and it regulates the currency and it regulates the monetary policy. What is monetary policy? The monetary policy, like you can see in point number 2 here, is basically referring to a set of policies which the central bank has access to. There is certain tools which the central bank has access to. For example, they have access to interest rates, they have access to money supply, the supply of the currency, quantitative easing, regulation of the banking sector, and so on and so forth. We're not going to go into too much detail. We're going to keep it very simple. The monetary policy is a set of tools which the central bank will use to alter your investments and to alter the economy, to change the economy and to change the performance of your investments. And they will do this in order to achieve a certain goal. Now, the central bank will have two goals, and we can see that here in point number 5 here. So I'm skipping a few points, we'll come back to them. But point number 5 here, you can see central banks, their aim is very simply mainly twofold. Yes, there is other smaller aims as well, such as economic growth, a healthy economy, and so on and so forth. But their main aim is twofold. Number one, to have inflation at the inflation target of that country. Keep in mind, not all countries will have the same inflation target, but of course, if we're looking at the main stable, strong currencies, such as the yen, the euro, the pound, the Swiss franc, also the US dollar, of course, the world's number one most traded currency, number one currency reserve as well, they tend to have that 2% target. So the central bank's target is to have inflation, which is basically price alteration. So for example, over the past 2 years, we have had very high levels of inflation, is to get inflation back to 2%. And also point number 2 is also to maximize employment. So we understand that the central bank is the regulator, is controlling the currency, is controlling the monetary policy. They control the monetary policy and the currency in order to achieve certain goals. These goals are inflation and employment. Now, the main thing which tends to be altered as part of the monetary policy, because, for example, yes, I have mentioned, the currency supply. quantitative easing, such as QE programs. We've mentioned as well regulation. These are aspects of the market which can't consistently always be changed. It takes time, it's a very large process. But interest rates, ladies and gentlemen, is something that they can change every single month. If it's needed, they can even announce an emergency meeting, an emergency interest rate decision, and they can very quickly change the federal fund rate, for example, for America, the central bank's interest rate. Now, this, which changes more often, is something that we as traders can use. Now, doesn't mean it has to change in order for there to be volatility. We of course have to keep into consideration that it has that lagging effect on the market. So if it's changed, it is going to have a big effect on the market, potentially over the next 2 months. But if it continuously changes, it can have an effect on the market for the rest of the year. So interest rates and its domino effect. So like I said, we cannot analyze all the tools within the monetary policy because they are rarely changing. But the one which is consistently changing, and we actually got this week the first time a concrete signal that it's going to change in 2024. We had this week for the first time from the Federal Reserve, and that is related to interest rates. So interest rates, how now that interest rates are likely to change, how are interest rates having what is known, we use it in the financial markets, this terminology, as a domino effect. So in other words, how does it have a certain influence within the market? Because people need to understand, people a lot of the time they think about employment, that it has an effect on the economy. They think about consumer demand, that it has an effect on the economy. They think about recessions and the stock market, how this has an effect on the economy. But everything at the end of the day is driven by interest rates. So even before there is an effect on the employment rate, even before the employment rate goes from 3.5% to 5%, if, for example, there's about to be a recession, it's being triggered first by interest rates. So before we even start to look at these lagging indicators, because all these indicators, they're lagging, employment, the non-farm payroll figure, the CPI, the PPI, these are lagging indicators. Interest rates is a leading indicator. So we're able to understand what type of price movement is potentially going to happen and likely to happen before the price movement even actually takes place. Whereas if we're looking to trade based on the news and trade based on lagging indicators, yes, there's advantages to this, and we're going to look at this in a different webinar, but it is a lagging indicator. It's the last thing which is going to change, whereas we want to also see the first thing which is going to change, which is going to cause everything else to change going forward. So this is why I put very clearly point number one, which is interest rates are used to control the economy. So like I said in the first slide, the central bank wants to achieve certain goals. Interest rates will be used to control the economy in order to achieve those certain goals. And I will explain exactly how as well, because even if we're not trading, this is something that it's very good knowledge to have on a day-to-day basis, because of course we have individuals who have mortgages, who are paying rent, who are thinking about purchasing a property. This is something that of course is even very important to these individuals. The central banks will use interest rates to reach their target. Higher interest rates result in higher cost of living and also more returns on savings. So two things: higher interest rates, it will influence the market in what way? If interest rates go up, the cost of living, everybody's cost of living, my cost of living, your cost of living, everybody's cost of living increases in value. And another thing is, anybody who has savings, my savings, your savings, the interest rates that the bank is paying us in order to save there increases. So instead of me saving $1,000 and being paid 1%, I'm saving $1,000, but I'm being paid 2%. Why? Because interest rates are increasing. So this is the first point about interest rates. The second point is that interest rates can decrease. And this is something that we're going to be paying a lot of attention to, because this is something that is being predicted for the first 2 quarters of 2024. When interest rates decline, then we actually have a cheaper cost of living. And in addition to this, whatever we're saving in the bank, we are paid less on. So, what type of influence does this have on our daily life? Whether we are an investor, or whether we are a consumer, or if we are a producer and a businessman. So let's look at higher interest rates at first. When interest rates are higher, there's a higher cost of living. So basically, when interest rates go up, because the banks which we're borrowing from, so our credit card bills, our overdrafts, our mortgages, and our rent, all of the debt that we have becomes more expensive. So on a monthly basis, because they're charging us more on our mortgage and on our rent and credit cards, we have less money. So if we have less money, what is likely to happen? We will spend less because we have less money. So this is point number one. Then we said we got more returns, more interest on our savings. What influence does this have? I will be less attracted to reduce my savings in order to make an investment, or to use my savings to go on holiday, or to use my savings in order to spend more this month. Why? Because I'm earning a decent amount of money on those savings. So when my wife comes and says to me, let's go on holiday with the family this year, I say to her, no, because my savings are not going to be touched. They're earning a very good interest rate. So what is this basically causing? Higher interest rates are slowing down the economy because we have less money to spend. Why? Because our cost of living is higher, and because people are less willing to use their savings, because a savings account becomes very attractive. So what target is the Federal Reserve and the central banks today? This morning we had the Swiss central bank. So anybody trading the Swiss franc, a lot of volatility there. The euro is currently, we got the president of the European Central Bank speaking at the moment, Lagarde, which I can see in the background there as well. She's creating a lot of volatility as well. The Bank of England spoke as well about an hour ago. So these individuals are basically speaking, and they're creating a lot of volatility. Now, high interest rates, they're there to achieve the inflation rate. Why are they being used, and why over the past 2 years have interest rates increased? Because when we slow down the economy, there's lower demand for everything that we're buying. And if there's lower demand for everything that we are buying, then people are less likely to increase the prices of goods and services. Why? Because demand is very low. So they won't increase prices. And what it does is it decreases inflation. Ideally, it's going to decrease inflation. Sometimes it doesn't decrease inflation. Then we have, of course, what we mentioned as lower interest rates. So when inflation, ladies and gentlemen, is too low, so let's go forward in 1 year's time. Let's say the monetary policy was too restrictive. And even though interest rates start to be cut, inflation actually declines to less than 1%, which isn't ideal as well. For example, in China, there's deflation, which is very negative for the economy. Now, when we've got lower than expected inflation, or let's say we need a stronger employment market, then the central bank will decrease interest rates. Why? Because everybody has more money to spend, they're more likely to spend that money, and it creates economic growth. And also, we're pretty much not getting paid anything on our savings when interest rates are very low. So people are more than happy to use their savings, or instead of looking at a savings account, to actually invest in the stock market, for example, invest in cryptocurrencies, and so on and so forth. So it creates a stronger investor sentiment, and it creates economic growth. So because of this, when we're looking at investments in terms of risk-based assets, so for example, stocks, indices, commodities, mainly energy-based commodities, not gold, for example. Uh, when we're looking at lower interest rates, then of course those markets perform very well. So you can see here lower interest rates, favorable conditions. Higher interest rates, actually risk-based assets do very poorly, and safe haven assets such as the US dollar and gold perform much better. So this is the reason why in 2022 the stock market completely collapsed. If we look at the performance of the Nasdaq over the past 10 years, the Nasdaq has only declined on two occasions. The first occasion was in 2018. Which it declined only by about 2%. That was because of the trade wars that Trump was bringing about. And the second occasion was in 2022, where it declined by 33%, so a very strong decline. That, ladies and gentlemen, was triggered by higher interest rates. So higher interest rates, less favorable conditions, lower interest rates, favorable market conditions. Now, alterations, and we're going to speak about what is about to be altered within the market. Alterations create volatility. So let's look at an example of volatility, ladies and gentlemen. By the way, everybody's got free access to charts, free access to trading platforms when you are signing up to our platform. If you go on HFM, you can very simply sign up. It costs absolutely nothing. You've got free access to education and free access to charts, signals, and indicators. So this is, for example, from our chart. It's from the MT5, which we provide to you for free. Here we've got the US 100 on the daily chart. So we can see the NASDAQ, ladies and gentlemen, and the price movement over the past 6 months. Not quite 6 months, almost 6 months, about 5 months. And we can see, ladies and gentlemen, that even though we were seeing a downward sloping decline, it wasn't a very strong decline because we did see times where there were strong buyers in the market. So, for example, here we could see buyers and here we could see buyers as well. Nonetheless, in the longer term, we were looking at a decline. But the market condition changed here. The market condition changed over the past month and a half. So why has the market condition changed? So let's look at here in the market where we really started to see for the first time strong bullish momentum. Here, investors started to price in lower interest rates and also a soft landing. A soft landing means we're able to bring inflation back to the 2% target, because in the US we're still at 3%, which is more than the target. To be able to bring inflation to 2% without it having a negative effect on the economy, without having a recession. So able to achieve that without falling into a recession, this is a soft landing. So the market started to see a big upward trend, a very strong upward trend, a lot of price movement, which people could have potentially have been profiting from. And the price movement was based on individuals starting to price in lower interest rates. And point number two, individuals started to price in a better economic outlook. And then yesterday's price movement was here, this candlestick here, which was one of the strongest price movements that we have seen. Increased in value by 1.65% in the 5 hours after the Federal Reserve's press conference. This, ladies and gentlemen, was triggered by the Federal Reserve for the very first time coming out and saying, we expect to cut interest rates in 2024. And I'll explain to you exactly, because not everybody has access to this. I will tell you exactly how much the Federal Reserve is predicting to cut interest rates. So central banks, interest rates, and forward guidance. What is forward guidance? The central banks will always give you a guidance for the upcoming months. When they give you a guidance for the upcoming months, of course, even though if a central bank doesn't cut interest rates, but they say they're likely to cut interest rates, then of course the market will price it in. even before it takes place. So something individuals need to take into consideration is, we're getting a lot of upward price movement, but keep in mind that price, which is currently where the Nasdaq is at the moment, this is based on investors believing there's going to be an interest rate cut. So it's not being priced because there's going to be an interest rate an interest rate cut. This is being priced based on the cut already. So the price movement has already happened based on the cut. This is something a lot of traders don't always understand, especially beginner traders. The market has already priced the interest rate cut in. So it doesn't mean because it's increased in value over the past month by more than 10%, that is going to increase another 10% after interest rates are cut. This is based on the interest rate cut. So the interest rate cut is already priced in the market. So the Federal Reserve is the first one we're going to be looking at. Interest rates in the Federal Reserve are priced at 5.25% all the way to 5.5%, depending on what interest rate you're looking at. So they're looking at the highest interest rate out there currently between the Federal Reserve and the Bank of England. How much are they predicted to cut interest rates, and when are they predicted to first cut interest rates? So they're predicted to cut interest rates, according to the Federal Reserve, to cut interest rates to 4.6%. So a much better outlook compared to what we're currently looking at. We're looking at cutting interest rates at least by 0.65%. Whereas if we're looking at market participants and economists believe they're going to go slightly further and cut interest rates to 4.5%. So a very small difference there. Of course, if they do cut to 4.5%, it's not being priced into the market. So that can create volatility. And then we have the European Central Bank. The European Central Bank is got the lowest, if we're looking at Western based economy. So not, for example, the Japanese yen, which has an unorthodox monetary policy. The European Central Bank is currently currently has interest rates at 4.5%. They're expected to cut second after the Federal Reserve, much before the Bank of England, but they're only expected to cut interest rates by 0.5%. Why? Because they, of course, have a very different traditional pricing compared to the Federal Reserve. Then the Bank of England has a very, very high interest rate compared to other regions. They're expected to only cut as well 0.5%. They're expected to cut third. So the first which is expected to cut is the Federal Reserve, the second, the European Central Bank, and the third is the Bank of England. Now, some people may say to me, why is the Federal Reserve expected to cut first? Very simply, ladies and gentlemen, because their economy is currently performing very well, even though there's signs of weakness. They're the first so far that have told us they're willing to cut interest rates. And number two, they are very close to achieving their 3% target. Whereas some economists also argue that the European Central Bank will also cut the exact same month as the Federal Reserve, even though they're refusing today. Today, they've actually refused to say that they're talking about cuts. Whereas most economists and most markets believe that they're going to cut at the same month of the Federal Reserve, even though that may not yet be priced in the market. Why? Some people may say the European Central Bank and the Eurozone's inflation is at 2.6%, ladies and gentlemen. So 2.6% is the lowest inflation that we have between the US, the EU, and the UK. So this is why individuals believe they will be right behind the Federal Reserve to cut interest rates at the earliest opportunity that they have, because also certain countries within the Eurozone are falling into a very shallow, very slight recession. Whereas the Bank of England is expected to be the most hawkish. Why? Because if we're looking, ladies and gentlemen, at the UK, inflation is above 4%. So there's a very big difference between the EU and the UK, where the UK is more than 2% higher in terms of its inflation rate. So the UK and the Bank of England is expected to be the most hawkish. So what does that mean? To cut less and to be the last to cut. Now, it's not necessarily hawkish, I'm using the wrong word. It's the least dovish. So they're still dovish, they're still looking to cut, but they're the least dovish. Uh, Bank of Japan is expected to see a slight interest rate increase, which is also why we've seen an end to that really strong bearish price movement against the Japanese yen. So let's look at this slide, very important slide. We're actually pointing out to you, based on surveys and market participants and economists, what is predicted to be the bearish the bearish currencies of 2024. This is extremely important, ladies and gentlemen, and what is expected to be the bullish currencies of 2024. So bearish currency number one, the US dollar. The US dollar is bearish at the moment, at least for the first quarter, if not the first 2 quarters of 2024, maybe potentially after that. In the last 2 quarters, we may see it regain back some lost ground. But based on what is being spoken at the moment, they're the only central bank which is coming out and saying that they're going to definitely cut interest rates in 2024. In addition to this, the economy is doing extremely well. There's a very high investor sentiment, a very high risk appetite. So because of that, most of the market participants are running towards the stock market and less towards safe havens such as the dollar. So this is the first bearish currency in terms of the outlook. Second is the Canadian dollar. Oil has significantly declined. Also, very poor economic data coming out from Canada, which is why also Canada is part of our bearish currencies. And then, of course, we have, as we always have every single year, the Turkish lira. The Turkish lira has been one of the poorest performing currencies. It is a failed currency. It has declined in value for almost 10 years consecutively now. If we're looking at the past 3 years, the US dollar has increased by 400% above the Turkish lira, and that is still expected of 2024. So 400%, ladies and gentlemen. It's a massive bullish price movement against the Turkish lira. And like I said, it is a failed currency, which is also why most market participants expect that to be definitely on the bearish side of the scales. Then we have the euro. The euro is in the neutral currencies because it is expected to increase in value against some currencies, but to decline in value against other currencies. So of course, if we're looking at the euro against the Canadian dollar, we are looking at a positive market outlook against the US dollar, at least for the first quarter of the year. Again, a positive market outlook as well. So this is why it's on the neutral side, whereas if we're comparing it to against the pound, then we're looking at a very different scenario. So bullish currencies for the year is the pound, because of it being the least dovish of the main central banks. The Japanese yen, because it's speculated and a lot of people are pricing in the central bank moving away from untraditional monetary policy, so negative interest rates, also a controlled yield curve. So all of this has already created the Japanese yen to have some bullish price movements, and is expected as well for potentially 2024. And then, of course, we've got the Mexican peso. A reason for this, ladies and gentlemen, I'm specifically referring to the Mexican peso against the US dollar. Number one, the US dollar is on the bearish side of the scales. Number two, because of the US trying to limit its reliance on China, they've turned to Mexico. And because of this, it's created a lot of demand for the Mexican peso. Now we're coming towards the end of our webinar. We're going to start to look at some examples as well, and start to look at the stock market, which is also one of our most traded assets on our platform, especially the euro, the dollar, the stock market, and of course gold as well. So here we're looking at, for an example, under stocks and indices, we're looking at the German DAX. But the same thing applies, ladies and gentlemen, to most indices. There's a lot of support for the stock markets, a lot of support both for European, Asian, and also US stocks. Why? Because inflation is very close to the target. Around the world, a soft landing is a higher possibility. In addition to this, interest rates are likely to decline as early as March. If we go back here, ladies and gentlemen, you can see this this chart down here. This is directly from the stock exchange. Here you can see, if you type in Google and type in CM Fed Watch tool, is exactly telling you what market participants believe is going to happen at each interest rate decision. So here we can see the interest rate decision for March, and we can see almost 75% of the market believe that the Federal Reserve will cut interest rates. So this is exactly what I'm referring to. Interest rates are potentially likely to cut. Because of this, we're looking at better economic outlook, consumer demand, other investments which are competing with the stock market, such as savings accounts, fixed accounts, bonds, and so on and so forth. They become less attractive. Because of this, we can of course see a very strong bullish price movement on the DAX. We can see on the Dow Jones. We can see as well on the Nasdaq. The one which is still increasing but underachieving compared to these assets is, of course, the S&P 500, mainly because it's more companies and it's more mitigated and they've spread the risk, but it doesn't always have that advantage. So we can see DAX has increased to its all-time highs. We can see we're above the price sentiment line. So this blue line here, which is the 75-day EMA, is the sentiment line. So if the price is above, so for example, here, the price is above, and here upwards, the price is above, is indicating buyers have controlled the markets. And ladies and gentlemen, we can see that anybody trading above this line, most of the price movement is upwards. Whereas if we're below, so for example, in this area of the market, most of the price movement is downwards, very simply. So here at the moment, we can see we're very, very high, and we're definitely in the bullish zone of the Bollinger Band. So here we can see a Bollinger Band. Now, this is all indicating that the price is in an upward trend and that buyers are controlling the market. But, ladies and gentlemen, we are very, very high now, and very, very far from our average price movement. And if we were also looking at oscillators, most oscillators would indicate the price was overbought. So even though, ladies and gentlemen, potentially we're looking at a very strong upward price movement, it's not just about that, it's also about our entry. So even though the price movement is upwards and we're looking at an upward trend and a lot of people want to speculate upwards, it's about also purchasing at the right price. If somebody came to you and said to you, I bought a house at 200,000, but everybody else bought at 100,000, people would not say that was a good move. Whereas if somebody came to you and said, everybody else is buying at 200,000, but I bought at 100,000, they would say that was a very good investment. So even though we're looking at an upward trend, it's also about what price is the right entry. So this is definitely something, of course, we have to take into consideration. Then here, ladies and gentlemen, we have our most traded assets. We have, of course, the XAU against the US dollar. In simple terms, we're looking at gold, ladies and gentlemen. This is a daily time frame. We've got an oscillator down here. This is the RSI on a 20-day period, and we've got our 75-bar EMA as well, which is our sentiment line. So we can see the sentiment line is very important because we can see it's acting as a support point. Previously, it's acted as a resistance point as well. Now, if we're looking at technical analysis, we have indications here of upward price movement and bullish price movement, and buyers holding and controlling the market. So here we're between 50 and 75, indicating buyers are controlling the market, and we're above the sentiment line, indicating buyers are controlling the market. So the opportunity there to speculate upward price movement. But, ladies and gentlemen, even though the gold is being supported by the US dollar declining, we also have to take into consideration that we're looking at very low risk very high risk appetite in the moment. So gold will have limited support. Most of its support is because of its correlation with the dollar and not necessarily because of high demand. So we have to be slightly cautious about that. But of course, interest rates will also have an effect on gold. So a quick recap, ladies and gentlemen, for interest rates for 2024, we have our possibly bullish market, which is basically the stock market, the pound, the Japanese yen, and the Mexican peso. We have our neutral, which is the euro, and we have our potentially bearish market, which is the dollar for the first 2 quarters of the year. And also we have the Turkish lira and the Canadian dollar. Interest rates for 2024, all are expected to cut interest rates except for the Japanese Bank of Japan, which is expected to slightly increase interest rates. Only slightly though, but it can create a lot of volatility, which is also why the yen is part of our bullish currencies. But at the moment, the first and only concrete signal we have of interest rate cut is from the Federal Reserve. So, ladies and gentlemen, we've been speaking now for 42 minutes. I will keep the webinar open just for 2 minutes. If anybody has any questions, feel free to, of course, ask some questions now. Be more than happy to answer as many questions as is necessary. Any questions, ladies and gentlemen, feel free to ask now. I will keep the webinar open for 2 minutes if anybody has questions. So I've got an individual who says he just joined. Keep in mind that you can, because this is on also YouTube, if you go to YouTube and type in HFM and you click on our website and you click on live, you can see the whole webinar again. So hopefully that's helpful. You can watch the webinar from the beginning because we spoke about what is going to happen in 2024, what type of price movements is possible, and also what is interest rates, what are central banks, and the basics as well. So what about gold? Is it going to keep going up? This is something which I just mentioned. If we're looking at technical analysis, the indication is that gold will increase. But if we're looking at fundamentals as well, the fact that gold is being pushed up higher because of the weakness in the dollar. But if we're looking at risk sentiment and risk appetite, more people are interested in the stock market and less in gold. So even when we do see upward price movement, it may potentially be limited. So if you want something which has a lot of volatility, upward price movement, then potentially you may also want to look into the stock market. Hopefully that answers your question. So let's end today's webinar. Can't see any more questions. Trade safe, ladies and gentlemen. Trade responsibly, as always. And hopefully we'll see you very soon on one of our webinars. We have a lot of educational material on our website. Like I said, you can sign in for free. We've got webinars, we have seminars, we have podcasts, we have offices all around the world, ladies and gentlemen, and educational centers with courses. Feel free to, of course, get access to that. In the meantime, trade safe, trade responsibly, and hopefully we'll see you very, very soon. Enjoy the rest of your day and your weekend. Goodbye.